Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. The Bank of Japan raised interest rates last week, causing a rippling effect that rocked global markets. The Japanese yen surged and the carry trade began to unravel. Global markets have rebounded since, but many investors are searching for answers as to what this means for the markets going forward. Could the carry trade continue to unwind? And what could the Federal Reserve's next move be as they look to cut interest rates next month? We speak to Fidelity Portfolio Manager Salim Hart to make sense of the latest events and what the Global Intrinsic Value team are positioning their portfolios for the months ahead. Salim recently visited Japan and provides insights into what the Bank of Japan could do next and what opportunities he's finding at the moment. He also discusses the newly launched Global MicroCap Fund, which taps into the broad and less explored market, and what opportunities he's seeing with newer, less established companies. This podcast was recorded on August 7th, 2024.
Okay, so let's begin with ultimately what we saw in that carry trade. We saw something that's worked for a long, long time just stop working with a surprise hike.
Yeah, and I think, it's an interesting perspective because the Bank of Japan has been warning investors, all the way from 150 to 160 on a yen per dollar basis. We don't want excess moves in the currency, right? And they said, kind of stop shorting it. There's going to be pain ahead. And I think they did not want to see what eventually happened. And I think global markets were obviously surprised by the extent to which the carry trade was prevalent and could have so much volatility in the market. So I think that was a little bit of a surprise to many people, just how far many investors have kind of piled into that trade.
It's a fascinating trade and it works so well. Is there more to unwind? I think that's what a lot of people are wondering.
I think there is, but I think the kind of forced delevering is probably over at this point. We talked a little bit about before the call, and the Bank of Japan has stepped in and said, has calmed markets down by saying they're not going to do any further moves until there's more calm and less volatility, not only in the FX market, but in the equity markets as well.
Because they can't be happy with this type of reaction.
They don't want big moves on either side, right? They really strive for stability, not only in their companies and in the way their economy works, their whole culture being there, is one about stability. So I think when they see this and they see their stock market down 12%, they think, we don't want this to happen in either direction, and I think we'll tend to provide warnings when things get too stretched on the upside, or in terms of a depressed yen, and also on the opposite side when things get stretched too far the other direction. So I think kind of them stepping in, often on Mondays is when a lot of the margin calls happen. So I think Mondays are just prone when you see global markets kind of close on their lows after a medium-ish drawdown over the prior couple of weeks. Mondays are often a time when books are settled up, mark to market, and margin calls are made. And I think you saw that in a big way on Monday. A lot of the forced selling carried over a little bit into Tuesday morning, but really I think the selling was concentrated on Monday.
Yeah, it's fascinating to watch that, and as you say, it sort of started in the weeks prior to that. Tell us a bit about the Fed story within all of this. There's lots that will opine that the Fed should have moved already, and that led to sort of this overall reaction. Bring it into the story from your perspective.
Yeah, the Fed probably should have moved, but to some extent, inflation is still a little bit higher than they'd like, and I think they tend to be one of very incremental and not wanting to react to different market whims. So to some extent, once they start cutting, I think it's probably true that they don't want to be forced to then have to raise again. So they're willing to risk a little bit of maybe more economic pain than people think in order to not kind of turn on a dime. So I think on Monday, when you were having people in the market making calls on major news programs for a 75% emergency intra-meeting cut, it's like, obviously they're not going to do that. They're hardly even making a comment to calm markets at this point. Partly because markets are, close to all-time highs, even with the drawdowns. On a 1-year basis, the S&P is up, 12, 13% still on a 12-month basis. Small caps had just had one of their best months in years in July. And yes, there's a little volatility, but the Fed is designed to make sure the economy and the doesn't collapse and the financial markets continue to function. And things were functioning fine. There was just some people on the wrong sides of their skis, upside down, and had to square off in that. And I think volatility is opportunity for the long-term investor. And I really believe, Pamela, that investors should use the volatility to make sure they're on the right side of where they want, right? So if they're underinvested and they say, I could use a little bit more equity exposure, vol exposure, small caps, micro caps, whatever the case is, they got beat up, use that selling to add to those names. And on the converse side now, the market's bouncing back, really, really well.
Everything,
if
the
you
breadth
felt like
is
in the
there.
drawdown, you lost sleep at night. NASDAQ 100 has bounced back a lot. So I've heard several investors I've talked to over the past week say, I didn't realize how exposed I was to whatever trade, AI trade, US large cap growth, whatever the case is. I need to be more balanced. And I think the market's providing you here some opportunity as it bounces back to make sure you're positioned appropriately. So use the volatility to your favor and don't panic. If you're not using leverage, which you should not use unless you're a very highly sophisticated hedge fund, and even then you shouldn't use it. There's no panic to sell or buy in either case. Be patient.
Okay. See the voice of reason from Salim Hart. We kind of needed that on Monday. Pick your spots. You mentioned microcaps as an opportunity. Yeah. Tell us about your microcap fund that was launched recently in recent months, and a little bit about what type of company size we're talking about. What is the cap?
Yeah, it's really exciting for us. This is not only Fidelity's first microcap fund that we launched in May, but from what I've heard during the launch process, the only microcap fund sold to retail investors in Canada. So a really unique opportunity. Pamela, in a space that's not crowded, provides great diversification for portfolios. It's kind of the opposite of everything I feel like is crowded in the world today. US, large cap, and growth, right? It is not only small, but microcap. It is very internationally focused with the majority of assets outside North America.
Interesting.
And it is a value approach that has been tried and true with Global Intrinsic Value and kind of my years at Fidelity, bringing together both quantitative and our fundamental research insights all across the world in a space that's quite inefficient. Really excited about it. A lot led up to this, but I guess the main things were we have a 10-year track record now on a microcap pilot fund that I've run very successfully here. So that allowed us to have a proof of concept for that. We have really exciting ways to process and read all the vast amounts of Fidelity research that we are doing. And we're using actually large language models and AI to help feed in and condense all that research for the microcap fund. And then just in terms of Joel's retirement and working through that, we're kind of past that now, and it gives us the opportunity to launch some new products and be proactive in raising assets.
I've got so many questions. So you answered a lot of them there, but there's more.
And there's so much to talk about.
There's so much to talk about.
Don't spend all the time talking about that. It's really exciting. I've done a lot of one-on-one meetings. We can definitely talk about the market, but please ask your questions on microcap.
Yeah. Well, so you mentioned most of it's outside of the United States. Is this across developed markets broadly or?
Yes. So it's the benchmark is MSCI World Microcap, which is developed markets only. We have the flexibility to go a little bit into emerging, but I don't do that very much because developed markets have rule of law, just kind of more stable, more transparent companies. And then this is really fascinating because if you look at any of the other major benchmarks, even MSCI World Small Cap, it's over 60% US.
Right.
The MSCI World Microcap is only about 25 to 27% US. So truly international, truly outside of the US, and truly amazing companies and opportunities and valuations to choose from. There's 7,000 to 8,000 stocks in our universe.
Okay.
So a vast array of just a number of companies to choose from. Really provide, I think of microcap equals opportunity, and that's kind of the title of a lot of my slides when I do presentations on the microcap fund. And you asked about cap, which I did not answer. We're cut off from adding a new position in the fund to basically the midpoint of the MSCI World Small Cap Index and below. So that's about 3 to 4 billion US dollars, somewhere in the 4 billion range Canadian and below. And in the fund, we hold everything. I think our smallest position is 18 million.
So that's small.
Yeah, so very small as well. Yeah.
And so most of it's somewhere in the middle, or what have you got there?
Yeah, probably like the midpoint, like half the fund's probably roughly below a billion Canadian in market cap, and roughly half of $1 billion Canadian market.
So you are meeting with presumably a lot of entrepreneurs. These are companies that you say that generally, I think you've said Fidelity tends to invest in things that have been going for a little while. They're not brand new companies.
I mean, my process does, right? Value, quality, a track record. I wouldn't say across Fidelity that's necessarily the case. I mean, we invest in private placements in Fidelity. A lot of the growth guys tend to be more early stage investments. So don't characterize that as Fidelity or not Fidelity. Characterize that as Salim Hart, Global Intrinsic Value investing. Kind of Joel Tillinghast's legacy, Morgan Beck and Sam Chamovitz. That's the more tried and true.
That's the more tried and true. Fantastic. Okay, it's really interesting to kind of hear about all this. Where do you see it as? So in the markets right now, it kind of depends on which part of the market you think we're in or cycle that we're in right now. But where does MicroCap fit, either as a complement or how do you see that fitting into a portfolio? Just take a for instance.
I mean, really high level, if you know Global Intrinsic Value, it's a global go anywhere fund with a value quality bet, very similar investment process, but it holds a lot of large, all across the cap spectrum, right? It's a very great kind of all weather, sleep well at night portfolio. If you look at its 5-year trailing vol, it's about 5%, right? So really strive to have a very high Sharpe ratio in terms of good returns, low vol, can serve as a really core equity holding. I think of MicroCap as a little bit more opportunistic and niche product. So while Global Intrinsic Value is probably a good product for a large position in someone's fund who wants a kind of a safer, very diversified alternative, I think of MicroCap as a really got a niche product that maybe should have a small allocation in everyone's portfolio, just because of the really interesting stock picking opportunities in the space, the fact that it's underinvested in, and it's really hard to do on your own for investors, right? Like, buying this tiny kimono rental company in Japan isn't something everybody's going to go out and do, whereas you can buy NVIDIA and Google and Amazon, Microsoft all day by yourself.
It's super fascinating because you're going into different industries and areas, as you say, that a lot of companies with different types of research structures couldn't. Tell us a bit about the opportunities that you can take advantage of. Okay, we know the big one that's just happened in the last sort of 72 hours, but go into maybe more micro opportunities ultimately.
Yeah, I mean, I do tend to be a long-term investor, probably a couple-year holding period, plus or minus, so 50% of turnover. So I'm not whipping the fund around, but it's great when we do have flows, I can allocate those to the areas that are the most dislocated or depressed. And we've actually had several since the fund launched.
Like, what do you mean? What sort of things?
So during the French elections, French stocks really sold off in a big way. And I was buying a lot of microcaps in France during that time. And really there was very little bids in the market, so I could just put in a bid, lowball bid, and often that would get hit. So that was an area, it was about 6 weeks ago or so, I think, that the French elections happened. Obviously, Japan and market dislocations just this past weekend and Monday. I deployed a decent amount of cash during that sell-off. I think
so. These are like macro events, really, like macroeconomic, geopolitical.
They're macro events, but they cause kind of valuation disparities at the company level, right? So I always have to assess price versus value, and when I don't feel like the value of a company has changed that much, but the price changes by 10 to 15%, that's a real opportunity to deploy capital in that area. So as an example, in the most recent sell-off in Japan, I had a big position in a Japanese drugstore. Staples held up really, really well. Plus the currency went up a lot, which means tourists to Japan might be less because the really weak yen has helped the tourism industry, and they tend to be a lot of the shoppers at some of the big drugstores, chains in Japan. And it was a flight to safety. So I was able to, sell that position and put it into some of the more cyclically yen sensitive names in the other direction, even auto parts, for example, that would get sold off indiscriminately and were beaten up. And there was a wide spread between names that were sold off and some of the flight to safety there, maybe a 20% plus spread. And those are the types of opportunities that I could take advantage of when there is a discrepancy between short-term moves and the long-term values of companies.
Those are fascinating examples, and just the most recent one of what the markets have gone through, it sort of goes into the other end of what we saw. So treasuries, we saw spreads ultimately across the board, gapping
treasuries
out.
Are fascinating, right? I mean,
are they? Okay, so I want to get
thought,
into this of where people sold and didn't sell.
Yeah, so people thought that the majority of the yen borrowing was to buy treasuries,
right?
At 500 basis points more of yield. And I mean, maybe some was, but you would have thought the treasuries would have gone down a bit as the unwind happened. You saw actually quite the opposite. So it told you that, I mean, yes, the flight to safety was overwhelming that, but that the amount of yen borrowed to buy treasuries was probably not as great as people were thinking. What you saw sold off was Japanese stocks, and partly that was a result of they're going to move inversely to the currency. So when the currency goes up a lot, but a 6% up currency move shouldn't translate to a down 12% Japanese market, right? Like that's just too big of a disparity. So I think you were seeing people buying Japanese stocks with the borrowed yen. And you actually know publicly Warren Buffett and Berkshire Hathaway have publicly disclosed that a few years ago they borrowed trillions of yen to buy a lot of the trading companies in Japan, Itochu, Mitsubishi, as well as half a dozen others. So they were actually borrowing yen at 0% rates to invest in equities, and I think you saw a lot more people than the market thought investing in that trade. And I think to some extent also U.S. tech stocks, right. Those did get hit quite a bit during the sell-off and during the unwind. So
and they've come back
there's probably a bit of buying what's working in the momentum trade that got unwound as people had to kind of reduce leverage in their books.
It was a beautiful moment of discovery, not necessarily price discovery, but just sort of discovery, because there's been that narrative in the market that, what do we do with the yen? If things do well, what will it mean for U.S. treasuries? And it sort of demonstrated, I guess, the risk that is or is not there, actually, for
yes.
that.
Yeah, definitely said where the crowded trades, where the weak hands were. And I think, this would probably be a question, but it just made me think of it. I don't know that a sell-off or dislocation like that has to necessarily mean anything for the markets in general over the next X number of months. You see dislocations at market bottoms. You see dislocations at market tops when just momentum gets too extended, and you see market dislocations in the middle. I mean, if you remember long-term capital management in 97, there was a short-term dislocation. It was a bigger than what we saw over the past few days, but markets bounced back and it didn't really affect the bull market of the 90s, right? So I don't know that there necessarily has to be a correlation between somebody's got caught on the wrong side of a trade and borrowed too much and had to unwind that. I don't know that has to necessarily mean anything for the market. I think this wasn't a question, but I'm going to answer it anyway. I think what's more important for the market is just economic growth, right? I mean, you've seen that over this whole Fed cycle. The market struggled a bit when the Fed first started raising rates because they thought that would mean lower growth. And as they realized the Fed's pretty far behind the curve, they're not actually that restrictive, and economic growth was fine, markets came roaring back. And through this whole cycle, even as the Fed stayed somewhat tight, whether they're talking about loosening or they're not, markets have done well because economic growth has done pretty well. So I think that's where investors' focus should really be on.
Okay, and so now you bring us into this Fed discussion. So it seems that there are cracks in the employment story. Whether they're big enough for everyone to worry about or not seems to be an open question. But there are lots of discussions that the Fed needs to be less restrictive at this point. Bring us into the economy, the recession risk, where the growth isn't. I mean, are you worried about U.S. economic growth?
Yes, but I'm a contrarian. I always worry about everything, and I'm always bearish. So I'm probably the wrong person to give you a balanced insight on that. But I can give you an insight just to provide fuel to the mosaic of people's thinking, right? Okay. That's probably why I'm here anyway. So let's think about, the market was pricing in Goldilocks because people were talking about Goldilocks economy, not too hot, not too cold. The Fed's going to lower rates before there's even any signs of economic weakness. And really, it's about what the market is pricing in. And I've said that for a while. We went from the market pricing in a mild recession with more rate cuts to the market pricing in continued growth with lower rates and rate cuts, right? So that's really important is what is the general consensus, what's in the valuation of the markets, what's being reflected in consensus thinking, but then also what happens. And I'm not an economist, so there's no point in me actually predicting the economy, but I will say I have multiple timing models that don't really feed into any specific investment decisions, but allow us to kind of systematically keep track of what's going on in terms of high quality, low quality, beta, things like that. And the worst thing for the markets, in the US at least, over time, and there aren't that many sample sizes because recessions don't happen that often, but the worst thing for the US market has been low and increasing unemployment.
Right.
And that is what you have right now. So going back to your comment on employment, I think that was a very, very good question, because I think that is what people should watch the most. Apparently the SOM rule, which has gotten a lot of press, has been triggered, which means the employment rate's up enough where in every prior instance, it means we were going into recession or we're in recession. And the market does not like it because people are losing their jobs. There's less consumer spending. And companies, it's costly to lay off people. Like it's disruptive to business. It means that they're not doing that well. Like a lot of things go into employment. So when you go from full employment to not full employment to a lot of unemployment, that is a really bad time, typically for the equity markets, because it's this place where you're coming from really good times, often Goldilocks economy, full employment, things are great, to less good times, and that incremental change can be difficult for the market to digest. So I actually think the sell-off that's been happening has probably been related to people now pricing in more of a slowdown than they were just say a month ago, when conversely we had a weak employment report, weirdly, I'd say early July, and the Russell 2000 had one of its best months.
Yeah.
I think the KRE, the regional bank index in the US, was up 25% in a matter of weeks. So it's a weird, people were obviously short that space at the time, but I think they were a little quick to react to what does that actually mean for potential economic slowdown. Now that's actually being priced in after the initial short covering and hoopla around lower rates, because lower rates will not be supportive for the economy for quarters, if not more to come, because the Fed's going to do it slowly, right? And it's taken time to slow down this economy. How many years? It's going to take time to stimulate it if that time comes. And when people are calling for the Fed should have done something, they're talking about the lags in monetary policy, right?
Right, which are always hard to sort of read as they swing. So super interesting. Circling back to some of your initial thoughts. So how long do you think it will take for the carry trade from the Japanese yen into other currencies and assets to unwind? You said maybe the hard pain has been taken, but it will continue.
Yeah. I mean, now that the Japanese market has bounced back so much and the yen has gone down again, reversing that, it's not painful anymore. I think it feels like the forced selling is done. So I would kind of put that in the rearview mirror, chalk it up to a lesson. When the US VIX gets above 50 almost every time, it's a good time to buy things, and then buy the most dislocated things for the short term. Not saying anything about the long term, but that's done. The VIX is back to 23 in the US. The pain's over. I'm not predicting runs to new highs in bull markets. I'm not saying that at all. I'm just saying don't worry about the yen carry trade unwind. That's yesterday's news.
Okay, great. And the next follow-up question is, how prevalent is this type of trade? A carry trade. A lot of people don't talk about that on a daily basis.
I mean, there's leverage in everything.
Sure.
I don't advocate it. We don't use it, but people are shorting there, even in long short funds, right? There's a certain amount of leverage in there where you can lose more than 100% in theory, right? And that requires margin calls, and that requires forced selling when things go wrong. So we're in a, my investment process, everything I've learned from Joel over the years, just how I think about the world is, you've heard the old quote, buy when others are fearful and sell when others are greedy. And I think if you follow that, then you will never get caught on the wrong side of an unwind, and can ideally take advantage of that. So I guess that's my advice, but there's leverage in anything. You just don't know before the fact which of the many things is going to get unwound and cause a pain trade. So given you can't know that, all you can do is carry some dry firepower, dry powder, and be able to take the other side when there are major dislocations in the market. And I feel like we did that to some extent earlier.
Okay, and it's so brilliant to have you particularly who are taking advantage of certain moments like this throughout history, but also recently. Give us a couple of broad strokes as we close as to how Global Intrinsic Value is positioned, maybe something on the MicroCap as well, because it's all the same approach, but just give us like a couple of top notes on positioning.
Yeah, I mean, we are overweight Japan. The types of stocks we own were not as affected as the overall indices. You saw major selling in Japan in crowded areas, tech, and also the financials, because people had bid those up a lot. So you saw a lot of unwinding of what was crowded. So I like to think that by investing in the uncrowded spaces, we'll be a little bit less affected by some of the market gyrations. What's not crowded right now? Definitely, I mean, I guess the things I mentioned, international smaller cap stocks, and value stocks are less crowded. I think things you saw go up in July, interestingly, some of the U.S. financials were obviously very underowned or heavily shorted. I think those could be affected in a recession, but I think have a lot of what will be affected in an economic slowdown is already priced for that, at least for a mild recession. So if you look at autos, auto parts, financials, especially in like the U.S., for example, a lot of those types of more cyclical stocks are actually priced as if, they actually are, some of them kind of in their own recession. Right. So I think by investing in those areas and picking the higher quality names in those spaces, you can kind of avoid them. And that's kind of what we're seeing. I mean, I mentioned France that we took advantage of. Consumer staple stocks are
out of favor.
Are very out of favor, as you know, for multiple reasons. Yes. Some of them have gotten affected by weight loss drugs, the GLP drugs, which are theoretically going to decrease food consumption across the globe, right? So others are just very out of favor, whether they make razors or sodas or things like that. Like they're just kind of ignored and forgotten about because they're not exciting. And I think a lot of those have some opportunities to invest in good companies that have very stable stocks.
Well, we're just delighted to have a chance to speak with you about so many things that pertain to what's going on in the markets, and also to hear sort of your calm, steady voice throughout it. Your voice held up well. We wish you continued, getting better. So thanks for joining us, Salim Hart.
Yeah, thank you very much, Pamela. I appreciate it.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.